A seismic event just shook the world of cryptocurrency. On November 19, 2025, investors pulled $523 million from BlackRock's iShares Bitcoin Trust, its largest single-day withdrawal since launching in January 2024. This outflow signals a dramatic shift in sentiment for what was once Wall Street's poster child for crypto adoption. The iShares Bitcoin Trust, the world's largest spot Bitcoin ETF, had been a magnet for mainstream investors, managing over $73 billion in assets. But this record outflow marks a sharp reversal, suggesting the initial euphoria is fading fast. The fund's value has dropped 19% this quarter, mirroring Bitcoin's own slide to a 7-month low. Even institutional-grade products aren't immune to crypto's wild swings, as this event starkly reminds us. Analysts, investors, and regulators are now left to dissect what this means for the future of digital finance. To truly understand the impact, let's break down what a Bitcoin ETF is and why it's become such a hot topic in both the financial world and the crypto community. An ETF, or exchange-traded fund, is essentially a basket of investments, like stocks, bonds, or commodities, that you can buy and sell on the stock market just like a regular share. A spot Bitcoin ETF, such as BlackRock's IBIT, is unique because it actually holds real Bitcoin, not just futures contracts or derivatives. This means the fund's value directly tracks the price of Bitcoin itself, offering investors a more authentic exposure to the cryptocurrency. When you buy shares of IBIT, you're essentially owning a slice of BlackRock's pool of Bitcoin, without the hassle of setting up digital wallets, managing private keys, or navigating complicated crypto exchanges. Before ETFs like this, investing in crypto was often confusing, risky, and intimidating for most people. The technical barriers and security concerns kept many potential investors on the sidelines, watching from afar. The launch of spot Bitcoin ETFs in early 2024 changed the landscape dramatically. Suddenly, there was a regulated, user-friendly gateway for both everyday investors and institutions to access Bitcoin through familiar brokerage accounts. Major financial institutions like BlackRock stepping in lent a new level of credibility and trust to the crypto market, fueling a surge of capital and sparking mainstream adoption on a scale never seen before. These ETFs didn't just make investing easier, they built a bridge between traditional finance and the world of digital assets, promising greater liquidity, transparency, and regulatory oversight. So, when IBIT experiences a record outflow, it's not just a bad day for one fund. It's a critical test of that bridge and of the connection between Wall Street and the crypto universe. The resulting sell-off shakes confidence not only in the ETF itself, but also in Bitcoin's stability and its future as a mainstream investment. It forces investors, analysts, and regulators alike to take a hard look at whether these funds can truly help stabilize such a notoriously volatile market, or if they might actually amplify the risks. The dream of easy, stable crypto investing just hit a major speed bump, raising tough questions about the road ahead for both ETFs and digital assets. Now, investors everywhere are left wondering if the bridge to mainstream adoption is as sturdy as it once seemed, or if it's wobbling under the weight of real-world market pressures. The $523 million withdrawal from BlackRock's ETF didn't just make headlines, it sent shockwaves through the entire cryptocurrency market, acting as a clear catalyst for the recent turmoil. This massive outflow is tied directly to Bitcoin's recent plunge, highlighting the deep connection between ETF flows and the underlying asset's price. Bitcoin tumbled below $90,000, marking its lowest point in 7 months, and jolting investors who had grown accustomed to a seemingly unstoppable rally and record highs. As prices dropped sharply, fear quickly took over the market. Many investors rushed to sell their ETF shares, triggering a domino effect that forced BlackRock to liquidate actual Bitcoin holdings to meet the wave of redemptions. This wasn't a sudden, out-of-nowhere crash. Instead, it was the culmination of months of cooling momentum following a speculative summer peak, as enthusiasm gradually faded and caution crept in. That summer peak, driven by excessive leverage and relentless hype, left the market exposed and fragile. When the excitement faded, the underlying risks became impossible to ignore. Breaking below the crucial $90,000 level triggered a cascade of automated sell orders, amplifying the panic and accelerating the sell-off as fear gripped the market. The ETF, being the most accessible and popular way for everyday investors to trade Bitcoin, bore the brunt of this intense selling pressure, magnifying the impact on the broader market. The result was a record-breaking outflow from the ETF, a clear and unmistakable sign that market sentiment had shifted dramatically from optimism to caution or even fear. The psychological impact of breaching key price levels like $90,000 can't be underestimated. Such moments often become self-fulfilling prophecies, fueling further volatility. This event is a powerful reminder of how quickly optimism can turn to fear in the crypto world, and how interconnected investor sentiment, ETFs, and the underlying asset truly are. Beyond panic, profit-taking played a huge role in the record outflow. Many investors, especially those who had entered the market early, saw an opportunity to secure their gains after months of impressive returns. The urge to lock in profits is a natural response when markets show signs of volatility, and this time was no different. Early IBIT investors, riding a wave of gains since January 2024, saw the recent weakness as a cue to cash out. For them, the sharp price movement signaled that the rally might be losing steam, prompting a strategic exit while still ahead. This is classic market behavior. When an asset soars, early adopters look for the right moment to lock in profits. The psychology of markets often drives waves of selling as investors try to outpace each other, hoping to maximize their returns before a potential downturn. The ETF structure made it easy to exit quickly, amplifying the single-day withdrawal. With just a few clicks, large and small investors alike could liquidate their positions, making the outflow even more dramatic. It wasn't just individuals. Bitcoin treasury firms, which had bought nearly $50 billion in Bitcoin, also started selling as their shares traded at a discount. These firms, responsible for managing significant corporate assets, faced pressure to act as the market shifted. Market skepticism about these firms' strategies added to the selling pressure. As headlines questioned the sustainability of their holdings, confidence wavered, and more investors joined the rush to the exits. For some, it was tactical profit-taking. For others, a reaction to fear. The emotional roller coaster of the market was on full display, with some investors calmly executing their plans, while others acted out of anxiety. Corporate players may have been repositioning in response to shifting sentiment. As the mood soured, many firms reassessed their strategies, reallocating assets to minimize risk and preserve capital. All these moves converged into one dramatic event, the largest ever daily outflow from the world's biggest Bitcoin ETF. The scale of the withdrawals sent shockwaves through the financial community, highlighting just how quickly sentiment can shift. It marked a clear turning point in the market's mood, signaling a new phase of caution and uncertainty for both individual and institutional investors. Experts say the crypto market's recent slide is more than a blip, it's a shift in psychology. Jose Torres of Interactive Brokers points to a lack of speculative spirit as the rally's fuel runs dry. Thomas Perfumo from Kraken calls it a hangover from last summer's leverage-driven peak. As the hype fades, over-leveraged investors are forced to sell, deepening the downturn. This painful deleveraging is typical of maturing markets, shaking out weak hands. The era of easy money is over. Investors are now more cautious and value-focused. The get-rich-quick narrative is giving way to a search for real, long-term utility. Until a new story emerges, the market may stay in this cautious, corrective phase. The crypto ETF boom's euphoria has faded, replaced by a sobering reality check. In uncertain times, investors flee risk and seek safety. As money poured out of BlackRock's Bitcoin ETF, gold's price held steady, or even rose. The contrast is stark. Bitcoin, once dubbed digital gold, is tumbling, while the real thing shines. When volatility spikes, many still trust gold's centuries-old reputation over digital assets. With economic worries mounting, risk appetite is shrinking. Bitcoin remains a high-risk bet. Gold is the classic safe haven. The shift from crypto to gold highlights the importance of diversification. Bitcoin and gold play very different roles, one for growth, one for stability. Investors are rebalancing, reminded that old lessons about risk still apply. The IBIT outflow is part of a wider chill across the crypto market. When Bitcoin stumbles, altcoins and other digital assets often fall even harder. This contagion effect drags down the entire ecosystem, not just Bitcoin. The sell-off could also draw more scrutiny from regulators, who hoped ETFs would bring stability. Instead, the volatility may prompt tighter rules or slow further integration with traditional finance. New ETF investors, lured by promises of safety, may now feel burned. Rebuilding trust will be a major challenge for the industry. The ripple effects of this outflow could shape prices, regulation, and sentiment for months to come. Crypto's wild side is on full display, and the consequences are just beginning. For everyday investors, this news is unsettling, but context is key. Volatility is part of crypto's DNA. Wild swings are nothing new. The ETF makes access easier, but not safer. Only invest what you can afford to lose, and have a clear, long-term strategy. Those who chased quick gains are feeling the pain. Diversified, patient investors may see opportunity. Herd mentality drove the ETF boom, and now the bust. Successful investing means resisting panic and focusing on your own goals. Use ETFs for convenience, not as a guarantee of profit. Diversify, stay informed, and respect the risks. This isn't the end for crypto, but it's a wake-up call for anyone underestimating its volatility. The record outflow from BlackRock's Bitcoin ETF is a major stress test for crypto ETFs. Their future depends on whether they can weather downturns, not just attract hype. Recovery will require renewed confidence in Bitcoin, perhaps through regulatory clarity, tech advances, or macro shifts. Asset managers like BlackRock must now focus on education and realistic expectations. The industry needs to move from hype to resilience, building a base of informed, long-term investors. This shakeout could ultimately strengthen the market by filtering out short-term speculators. The path to mainstream adoption is tougher than expected, but not over. Crypto ETFs have just received a hard lesson in reality, and their response will shape the future.